Well, at Oakmark, we're always thinking much longer term than just seasonally. And as we look at things, the S&P is trading at about 20 times next year's earnings. Maybe you could adjust that down a couple of points due to deficiencies in GAAP accounting and how it treats intangible investing. And you compare that to a bond market that's yielding less than 2%, a negative real return. I just don't think there's a strong argument against equities. And within the equity market, we still view it as kind of two-tiered, where there are a bunch of stocks that are really cheap, especially financials and energy, and then a bunch of stocks that are really expensive. And I think the cheap stocks are cheap enough that a value portfolio today looks pretty typically valued. So we're excited about the prospects for the returns we think we can get at Oakmark.
Tell me more about how cheap you think the banks are and whether or not the run they've had makes them less cheap, obviously, than they were maybe 6 or 7 months ago.
Well, a large holding for us is Ally Financial. It was a horrible stock into the early part of the pandemic, but it's had a really strong recovery. And it's rallied now to the point that it's selling at about 8 times expected next year's earnings, relative to a market at 20 times. Or you look at another large holding like Citi, where we think Jane Fraser is doing a great job of rebuilding the corporate culture there, focusing on the customer. The stock sells below book value, a single-digit PE, yet she believes, and we think this is likely, that over the next 5 years they could almost double the return on equity. And there'll be a lot of capital getting returned to shareholders over those 5 years. So I think the banks are really cheap, despite them having been good performers over the past year.
Bill, looking at the performance of the Oakmark Fund and the Oakmark Select Fund, you've vastly outperformed the broader market. And so where have you been getting that so-called alpha or that outperformance from in terms of your selection versus what we would see in the broader market?
Well, David, if you look back over like 4 years during this period where value was so horrible relative to growth, the good performance the past year has basically been the reversal of the names that hurt us so much in the prior 3 years. So from 2016 to 2020, banks and energy were difficult holdings for us, and those have been among our strongest performers over the past year. And then relative to other value investors, we've got a somewhat more inclusive definition of value, adjusting GAAP accounting for what I refer to as deficiencies of treating with income statement investing. So we own names like Facebook, Alphabet, Netflix, because we think they're cheap relative to business value, and GAAP accounting isn't doing that justice. So that's been a large part of the strength in our portfolios.